Hello, everyone. How you doing? What's up, everybody? Welcome back. Welcome back. Sorry, got the setup looking a little weird today. I don't know exactly what it is, but setup's looking a little bit weird today. But your boy is back home. Maybe you know what? Maybe it's this. Maybe it's this light. I feel like this light's brighter than normal. There we go. Let's kind of tune that down a little bit. What's up, everybody? How's you been? How you been? I was out in Tennessee for the week. Some of you guessed it. Some of you didn't. I was out in Tennessee. We went to Gatlinburg for a couple of days to visit, or just to hang out with the family. We do a little family vacation every year, and so we were out there. It was me, my wife, one of my best friends, my mom, my mother-in-law. It was a good bit of us. We were out there hanging out. Went to Dollywood, did some theme parks, did some hiking. That was good, everybody. It was good. But as per usual, I'm glad to be back. I haven't been live in over a week, and I feel like you guys have been panicking. Joking, but we have a big day today. We have the FOMC meeting today. They are going to obviously cut rates. I think that's pretty obvious. But the question is, how much are they going to cut it by? Probably 25 BPS. And then obviously we need to check in and see what Jerome Powell says after that. Because, at the meetings, things can either go real good or real bad. And I think the market's going to be a little bit dependent on that. So today we're gonna keep an eye on all that stuff. It's gonna be a good day no matter what happens. I know the market's down a little bit, but that shit doesn't scare us anymore, does it? And yeah, we're gonna go from there. Get a little phone call here from my sister. Don't know what she wants, but I'll call her back later. But yeah, anybody. Well, listen, it's been a good bit of days. So look, this is the game plan for today. So it is currently 12:30. The FOMC meeting is in 1 hour approximately. We have the interest rate decision that is going to come out in 26 minutes. So we're going to check in. We're going to do some technical analysis for the next 25 minutes. Show you guys what's been happening in the market while I've been gone. Then we're going to take a look at the interest rate decision. We're going to read through the little post report, whatever it's called, document. We're going to read through that. We're going to hang out. I'll answer some questions. We're going to listen to what Jerome Powell says. I'm probably going to get a little unhinged, say some crazy stuff that I'm going to regret. And then, yeah, we're going to go from there. But yeah, anybody. But before we do that, welcome in, welcome in, welcome in. Happy to have you all in here. Fishy, what you doing, my boy? Now we're buying right now. Bye. Let's turn up. Let's go. You should always take your sister's call. We talk every day. It's okay. Larry, shout out to you, homie. Welcome in, welcome in, welcome in. Have you had any Tennessee barbecue? I did have some Tennessee barbecue. A black guy hiking. Yeah, absolutely. I ain't too scared of the woods. I live next to Gatlinburg. Wish I could have met you. All good. Next time. Nah, we didn't hit up Nashville, but I was there last year. Maybe you know where Sam disappeared. Sam is, he got a copyright strike for no reason from YouTube, so he can't post for a week. All right, shout out to you, everybody. All right, happy to have you all in there. Happy to have you all in here. Well, look, without further ado, let's go ahead. Let's first and foremost start off with some technical analysis. I got my wife's rainbow cup, and I'm ready to get some damn TA going. So buckle up and let's rock and roll. So let's get into it then, shall we? So let's start over here. So what we're going to do is let's first and foremost start off on Bitcoin. Actually, look, let me just kind of go through a market recap real quick. So over the last day, basically last 24 hours, everything is down. Definitely seeing a good little pullback here over the last 24 hours. The last week is still looking actually rather positive for most of these. Actually looking really good for the 600 to 700 right now, which is pretty cool. Yeah, smash that like button on the way in. So that's looking pretty good. 900 to 1,000 looking decent as well. Got some XTM, some Luna, not doing that again. Blog Vader. Okay, cool. So the market's looking pretty decent. Actually looks pretty decent over the last week. We are still up in general over the last week. As you can see, the market has recovered a little bit, but obviously the short-term time frame's looking a little bit more rough, especially over the last 24 hours. Now, this pullback is actually something that we were in many capacities expecting. I'm not going to say we knew it was going to happen, so maybe that's not fair, but it is something that we are definitely prepared for. If you guys go look at my channel, actually, I made a video not too long ago. Right here. So I said crypto update. I just made some buys and sells. And in this video, what I told you all was, listen, I'm really glad that we're seeing the market pushing up right now, but I am getting concerned about the amount of liquidations that we're seeing in the market right now, especially towards the downside. And so because of that, I'm going to take some profit off the table. And so I'm going to get into that in a little bit. I'll break that down a little bit more in a few minutes here. But we did recognize like, hey, things are looking a little bit suspect right now, right? As Bitcoin was hitting like 115K. So we did take a little bit of profit off the table. Now, when we do look at this market in general, though, this little pullback that we're seeing right now isn't anything to freak out about. Truth be told, I don't really know why people are freaking out. I don't even know what's so scary about this. I'd actually say that right now we're in a really good spot. We saw Bitcoin's price bounce. We saw, for example, Bitcoin's price lose the bottom side of this massive red zone that we had been in. It fell out of of it, came back down to this trend line that we've been finding for support at. I mean, we found it back here, we found it back here, we found it back here. We found some support on top of this massive blue trend line. We use that trend line to push back up into the red zone, into the red range. We pushed back up into it. We came back down. We back tested it, successfully got this support, reestablishment of support right here. Boom. We flipped this into support again. We then use the support just right here. Boom. This right there to push back up towards the upside, set a new local higher high, and reclaimed 116K, pushing up into the midterm resistance or the mid-range resistance level right here. So all in all, I mean, I think this has been a beautiful move. And sure, it's pulling back a little bit, and sure, it's cooling down, and naturally it should. What you have to understand is that Bitcoin's price had to make a hard move. It lost support, regained support, and then back tested and continued back upwards. And it was a very difficult move for Bitcoin to make. That wasn't easy. And you can see that by the 4-hour RSI, for example. We had this low, we had a lower low, we had a low, we had a higher low. This was bullish divergence. I called this bullish divergence right here. It's the reason why we went in and we bought some Bitcoin, right? 1 second. 1 second. 1 second. I don't know. I can't find it. It's somewhere in here. You probably see it and I just don't see it. But again, we went in, we bought a little bit of Bitcoin right here on this bullish divergence, and it made a very difficult move back into this range. So naturally, after Bitcoin's price makes a hard push back upwards, it is going to cool down. It's going to pull back. It's going to reset. And that's exactly what's happening. If we look at the 4-hour RSI right now, this bad boy ran all the way from 76, guys. That is a very high level, okay? All the way from 76, all the way back down to currently 40. Now, yeah, sure, we're not sub 30 yet. So this could have a little bit more of a pullback to go, but this little bitty pullback correction right here has reset that 4-hour RSI nearly completely. Now, at the same time that we're seeing Bitcoin's price see a beautiful reset on the price, we're also seeing those liquidations that I was looking for actually happening. What you can see is that Bitcoin has now come down and nuked so many of those 7-day liquidations that we've been concerned about for the last couple of days. Matter of fact, a couple of days ago in that video right here, hold on, let me see if I can actually find, if I can pinpoint, what was that? That was weird. Did y'all see that? Oh, gotta watch ads. I hate this. I'm on my second channel. But look, let me see if I can show y'all what it will look like. Yeah, look at this. So look at the 7-day Bitcoin liquidations. I mean, at one point we were seeing like $10 billion worth of liquidations to the bottom side, no liquidations back above us. And so I said, listen, this is sketchy. We need to come back down, maybe pull back and reset some of this a little bit. And look what's happening. Now, when you update it, look at how so many of those liquidations have been nuked. Now, not the majority. There are still some below us. And so sure, yeah, Bitcoin's price might come all the way back down to say 108K, 107K, but it doesn't really mean anything. It's not a super big deal. It's a reset. And as long as Bitcoin does not fall below this previous low and it doesn't fall below this blue line of support, we're in a good spot. So everybody who's been freaking out for the last fucking week, they just need to calm down. It's like, dude, we're just resetting. What you can't do is freak out every single time Bitcoin pulls back. You know, I checked my Twitter earlier today, and so many people are like, Bitcoin went from 116 to 111. I'm so tired of this market. I can't stand it. Why can't we get a pump? I'm like, dude, we've gotten a pump. Bitcoin's price from the low that it put in to the top that it put in pumped 12.5%. This is a multi-trillion-dollar asset pumping 12% in like 8 days. If you don't think that this is a pump, you've lost your mind. You've just become very delusional and naive to what really happens in these markets. And sure, there are bigger pumps like this. Yes, it was a bigger pump, but this is still a pump, and this is a pullback. This is a reset. And as long as Bitcoin's price does not fall below this blue line and fall below this previous point of support, this is nothing more than a reset. And that's what I think that this is. And I don't think it's anything bigger than that. Look at the 30-day liquidations, for example. Sure, there are some still to the downside. The majority are still above us. Look at the hyper liquid liquidation map. Look back to around, say, $100,000, which is just right here. Then look at the sheer amount of liquidations above us. There are still so many people to be destroyed to the upside. The market manipulators would benefit greatly from pushing the price to the upside. And so all in all, I still think there's a lot of upside potential here. You factor that in with the fact that we got BlackRock accumulating. You factor that in with the fact that, here, let's go over to Connor's Connor posted something about this. Boom, like you got guys like Tom Lee, $130 million purchase. You got BlackRock just added $58 million in Bitcoin. There was another one, that whale. Hold on, where's he at? By the way, you got to kind of follow Connor. I hate Connor, but you got to follow Connor on Twitter. He's really good. Boom, like the whale, boom, going in, adding big $500 million on all of these long trades. And does this mean the market has to move upwards? No, but market manipulators would benefit from the market going up over the long term. They would benefit from the market going up over the midterm. And so what happens right here doesn't scare me. Yes, we might come back down to 106K. I don't care. Yes, we may come all the way back down to 103K. I would start to care a little bit more, but I still really wouldn't care that much, because until we definitively break through this zone right here, look, let me make this very easy for you. Until we break definitively through this zone right here, that yellow zone, I'm not scared. And I have no reason to be. If we didn't lose it right here, I don't believe we're going to lose it right here, especially now that things are starting to ease. You got to understand that when we fell down here this time, guys, we fell this low when we were starting to see scares with the tariff situation. There was 15 or 20 billion dollars worth of long liquidations below us. I mean, there was a perfect storm for us to fall below 100K, and we didn't right there. So why the hell would we do it now? I just don't think that's going to happen. And if it does, it is what it is. I'm wrong. I'm a man who can admit when he's wrong. It is what it is. I just don't think I'm wrong. And so what am I going to continue to do? I'm not going to continue to do too much. If we come back down to these lower levels, yes, I will accumulate down here happily. If we continue to pump to the upside off here, yes, I am going to continue to take profit because that's the game that I play. I buy whenever the market is low. I sell when the market is high, which is exactly why we went in and why we did some taking profit a few days ago. Go watch this video right here. Again, I just made some buys and sells. And what I told you in that video was, listen, Bitcoin is pulling up to the mid level of this range between the bottom side and the top side of this red zone. And right whenever it gets to this little mid range, what you can see is that historically it does struggle a little bit. You'll see it find some support. You'll see it find some resistance. Getting rejected from this little level is not super uncommon. And so knowing that we had did some purchases right towards the bottom side of this zone, guess what, guys? We went in and we we're like, look, you know what? Our Ethereum bag is up, our Solana bag is up, our Bitcoin bag is up. We're going to take some profits off the table. And so just like I told you on YouTube and just like I told you over here, as you can see, we went in, we took a little bit of profit off Ethereum when the market was pumping. We took some profit off of Solana when Solana was pumping. We took some profit off of Bitcoin when Bitcoin was pumping. And that's the game that we play. We take profits when it's up, we buy when it's down. And so if it continues down, I'm going to accumulate. If it goes back up, I'm going to take profits. And we do it over and over and over again. I mean, how many times do I have to say the same thing on these live streams before it clicks? You just have to play the game as the game was meant to be played. And so this pullback right here is not scary. It's natural. It's normal. It's expected. They have liquidations to the downside. They're going to go get them. It is what it is. And one day, enough people will get liquidated to where we start to see these long traders start to really give up. We start to see the shakeout finalize. And then from there, sure, I think the market's going to try to run. I think Bitcoin, I think ETH, I think Solana, I think these cryptos are going to try to push towards new all-time highs. And sure, it might take 3 months. It might take 6 months. I don't care. I didn't enter into the crypto market to get rich fast. I just entered the crypto market to get rich at some point. God damn it. And eventually, if that means I got to wait 6 months, cool. 3 months, cool. 1 year, cool. 4 years, cool. It is what it is. But seeing a little pullback like this and freaking out makes you a crybaby. And so if you've been freaking out over the last few days because it pulled back from 116 to 111, especially after what we've been through the last few weeks, guess what? You're a crybaby. Okay. Simple as that. You're a crybaby. You need to get over it. You need to thicken your skin up. You need to grow up. Crypto is hard, but it's rewarding. Grow up. Okay. And so with that in mind, that's where we are when it comes to Bitcoin. By the way, guys, I was just joking. Me and Connor are best friends. I'm in his wedding. Relax. I don't hate Connor, even though I do hate Connor. But yeah, so whenever it comes to Bitcoin, that's where we are. Now, when we start to shift over to Ethereum and Solana specifically, okay, the game is very simple, guys. I don't know what else. I mean, I don't even know how much more I can continue to say this, but Ethereum's price is in a descending channel. I buy in the green, I sell in the red. Guess what? Last week, what did we do on live stream? I bought Ethereum twice recently on live stream in the green zone here, in the green zone here. And I told you all, listen, when its price or tries to return to the red zone, I'm going to take some profits. And at the worst case scenario, it just nukes through this and I'm just wrong. It is what it is. But guess what? I wasn't wrong. And these things don't usually end up making me wrong. It's just not normally what happens. And so what happened? Ethereum's price off those two purchases that we did ran all the way up into the red zone, went over to the Discord and told them, hey guys, look, we're right in the red zone. We're getting very close to it. I'm taking some profits off the table right now. Boom. And next thing you know, ETH's price is now pulled back. And now we have an opportunity. We could take a little bit of cash, throw it back in if we want, or we can sit on that cash. We can go do something else, buy some ramen noodles or something. I don't know. I like ramen now, by the way. And so with that in mind, when I look at Ethereum's price, my game plan is simple, guys. If it bounces off this 50% threshold, pushes into the red zone, I'm going to take more profits. If it drops to the green zone, I'm going to buy more. And I'm just going to do this over and over and over again until ETH breaks out of this channel. It'll break out eventually, and I'll just keep doing this until it does that, okay? Now, Solana, very similar story. I told you all in that live stream, we were live right here, actually. I didn't get live on this one, but I was live right here as we were pulling back into this dip. And I told you all, listen, I'm going to buy a little bit of Solana here. I'm going to buy a little Solana here if its price can continue to do it. Now, I didn't buy a lot because I was very skeptical of Solana. I will admit, and I'm very open about these things. I am very, very, very open about these things. I didn't buy a lot because I was skeptical, but I still purchased because my strategy said to. And so we did did some purchasing on Solana, and I told you exactly what I would do. I said, if Solana's price pushes back up to the red zone, guess what? We're going to take profits off the table. So yeah, even though Solana's price is down a little bit right now, it is still in a take profit area because it is right around this red zone. And so it's a great time to take a little profits. If it pushes up higher, take a little bit more. I personally wouldn't be taking a ton of profits off Solana though, because of what we have been seeing from an institutional perspective. As you all said, or as you all saw, our least favorite redhead in the whole world, Bitwise, their ETF, boom, live, boom, that's live now. And then we saw the Grayscale one. I think he posted about the Grayscale one as well. Yeah, so the Bitwise Sol ETF did around like $70 million worth of inflows, which is absolutely nuts. And then a couple hours later, Grayscale went and launched their own one. So you remember in this video right here, I told you all one of the easiest ways to look for altcoins that are going to pump. It was in this video. I said one of the easiest ways to look for altcoins that are going to pump is look for what institutions are buying. Yeah, well, guess what? Institutions are buying Solana. They're betting on Solana. We also saw, let's go see what our least favorite redhead posted. Where was that at? I know I saw it just now. Boom. So that whale that's been like timing everything perfectly, probably Barron Trump, he just opened up a Solana long trade, 10x leverage, $10 million long trade. He's betting on Solana right now. We're seeing ETFs inflow into Solana right now. So Solana's getting a lot of traction. It's getting a lot of momentum. And I think there's a world in which Solana is about to catch its second wind. We saw a huge move from Solana throughout the majority of this, right? I mean, go look at what happened. Like last year, Solana was the play of the cycle, realistically. And we bought that bad boy down at $17 here on the channel, way down here. We bought some Solana, rode that puppy all the way up towards $250 to $200, took a whole bunch of profits off the table right now, and then it's going sideways since then. And so maybe Solana is about to catch its next wind and maybe try to rally. Now, obviously not up here. Don't get me. I mean, don't be a fool, right? But maybe Solana pushes up to $400 or $500, right? And so no, I'm not selling a whole bunch of Solana right now, knowing that there could be some solid institution-backed gains coming. But I still would take a little profit off of Solana because what if they're wrong? What if it doesn't pump? What if we go into an altcoin, altcoin season which is not looking good or something, and Solana just doesn't handle well? So yes, I will take a little profit off the table, but I am being aware that there could be more macro upside potential because of all this stuff we're seeing right now with institutions. So I'm gonna leave a little bit of that Solana bag open. We'll just kind of see what happens there, right? Not too stressed out about it. So that's what we're looking at whenever it comes to Ethereum. That's what we're looking at Solana. So we're looking at when it comes to Bitcoin. Now, we have 10 minutes until the Fed makes this decision, so I'm going to keep the ball rolling. Now, when I look at XRP, I've told you guys very simply what to do. I said, guys, don't get too damn excited about XRP till it breaks above 270. Why? Because support, resistance. This is a massive resistance zone. It is going to be hard for XRP's price to break above it. It needs to recapture that zone. We need to get above this liquidity because while we're below it, we're also running into this resistance, this resistance, this resistance, this liquidity right here. We had that little support right there. As you can see, that's going to be resistance. This is resistance. This is resistance. This is all resistance. There's a fuck ton of resistance right here at 270. So guess what? While XRP is below 270, big risk. Leave it alone. Don't buy it. Leave it alone for a little bit. Or, I wouldn't buy it. I'm not telling you not to buy it, but I wouldn't buy it. I'm leaving it alone. I want to see XRP recapture 270 because if it can, the door of opportunity opens. How far could it pump? I don't know. But I do think it is well within reason that if XRP reclaims back above, say, $2.70, maybe breaks above this trend, I easily could see this bad boy reclaiming back up to 319, maybe pushing even as high as 338, which would give us a macro confluence because, of course, that is the top side of our fib golden zone on this move here and on this move here, right? Pushes up around 327 to 340. So yeah, I think if XRP reclaims 270, we could have some pretty sizable substantial gains of 15 to 30% in front of us. But it's not there yet. It's still below 270. So leave that shit alone until it gets above 270. Stop overcomplicating everything. Next, looking at SWI. Everybody's been talking about SWI the last few days, but they shouldn't be talking about SWI quite yet because SWI still has some work to do. What we can see is that SWI is still trying to get some confidence to it right now, right? You see how SWI had this ascending channel right here, right? And then it broke to the downside. Gladly, we took profits off the table up here, recognizing this ascending channel. Well, I told you all, look, if SWI breaks out of this ascending channel, there's 3 levels it's going to go to. The first one's going to be 306. The next one's going to be 229. The next one's going to be 169. Now, technically, it hit all of them in this pullback, but it is still really bouncing around this 229 level right now. Why? Because it's a bounce zone. It's a previous zone of support. You see that support? Now it's support here. And so SWI is trying to use this as a bounce zone. So it needs to get some confidence. It needs to get some momentum. momentum. We need to see if SWE can actually maintain some support here and use that support for the reversal, clear back above $3 and start to actually give us some gains, some momentum. Because while it's still sitting on this bounce zone, it's just teetering on a cliff. And so he's about to make the decision if it's going to be like the lady from The Conjuring and Devil Made Me Do It and just jump off a cliff, or if it's going to get away from that cliff and start to work itself back up towards the top side and give us some gainer waners. Okay. So don't freak out with SWE right now. Stop panicking. Just wait and watch. And let's see, okay, can we use this support? Can we push back above $3? Boom. Okay, great. Now we're probably going to give us a push back up to $4, $4.50. Now we're in a good spot. But if that thing wants to jump off the cliff like that lady in the movie, well, guess what? It's probably going to come back down to some of these lower levels, probably revisit $2 or below, and then we'll just go from there. So SWE, stop panicking, stop freaking out, just wait. Draw on your level at $3, draw on your level at $2.29, and just wait. Very easy. Okay. All right, next up, let's go into a few more rapid fire style because we have 7 minutes. Whenever it comes to Here we go. So whenever it comes to XLM, let's kind of extend this out. I didn't get a chance to extend it before I went on my trip. Boom. You guys already know what I'm going to say, but I'll just still say it anyway. But with XLM, very simple, very simple, very simple, guys. You know what to do. Red zone, take some profits off the table. Let that bad boy rip a little bit. Let's see if it wants to give us that breakout and actually complete this move that it attempted to make up here, because it did fail it back here, right? So XLM easily could have just gotten rejected back into the channel and about to pull back into this green zone. So what do? You take some profits off the table if you snagged a buy in the green zone down here anywhere, which I did not. I was not fast enough. And you just let that puppy ride. If it breaks out, great. We reestablish. We look for the breakout back up towards 41 cents, maybe even ride a long trade with the descending channel stop loss somewhere in here, right? Boom. Long trade here. Boom. Trying to ride that puppy back up to 41. You see how we had this resistance? That's going to act like a magnet. It's going to try to pull XLM's price back up there if we break out. So yeah, maybe ride that long trade up there, see what happens, take profits like 80% of it at 41 cents or a little bit lower, like 39 cents or something. We'll see. But it's not there yet. We're still in the descending channel. So what do? Buying the green, selling the red, wait for it to break. Very simple. H bar. Everybody's saying, call your sister, call your sister. Let me make sure she's fine. Hold on. Y'all stressing me out. Oh, she's fine. She just wanted to know what day I'm going to visit her. Okay. H bar. Boom. What's H bar trying to do right now? It's actually doing. Okay. So H bar is actually trying to give us a pretty interesting move right now, but it's not completing that move yet. Do you remember whenever H bar's price started to pull back to the downside right here? I told you all, listen, we have a lot of support between 18 and 12.5. So now that it's in this yellow zone, I wouldn't be surprised to see it try to give us a return back towards the upside. Well, that's what H bar is trying to do right now, but it's struggling a little bit. What's it struggling with? Well, it's struggling to break through this descending level of resistance. You have resistance here, you have resistance here, you have resistance here. So guess what? Now you got it here. So what H bar is trying to do is it's trying to break above this blue line to reestablish a foundation that it can use to recapture some of this liquidity. But guess what? It's going to be hard. There's so much liquidity right here. Everything that is in front of us is resistance. And so H bar is going to struggle a lot over the next couple months trying to break through this zone. Not only does it have this liquidity-based resistance, but it also has Fibonacci-based resistance, not only from the macro sense, but also from the micro sense. Do you see how we have this golden zone right here that we're in this golden zone back above us? You know what that means? It means that H bar is going to really struggle. It's going to be extremely hard. And if it breaks above 30 cents, it's in a very good spot. But while it's between 20 and 30 cents, this is a battle zone. I mean, this is a war zone. And if you're thinking this is going to happen quick, fast, easy, or anything, you're wasting your time. This is going to be difficult for H bar's price to break through. And if the time does come eventually, well, great, cool. Then it's going to make that move. And yeah, sure, H bar pushing up to some Fibonacci extensions. H bar trying to give us a runner up to, 55 cents, 83 cents. Sure, I don't see a reason as to why that can't happen. But it's not going to happen anytime soon. Not while it has all this liquidity in front of it that it's trying to figure out. So just wait, be patient, stop freaking out. You get what I'm saying? Do you kind of see what I'm getting at here? The majority of the market is just in a spot where it is continuing this move, is continuing this correction. And truthfully, most of it's just following Bitcoin. Why? Because look at what Bitcoin's doing from a macro perspective. From a macro perspective, Bitcoin's picture is very clear. Bitcoin's price made a rally all the way up towards a new all-time high and is now getting dribbled like a basketball between this previous all-time high right here, boom, at $107.7 thousand and the new all-time high that we've created around 126. And so Bitcoin's just dribbling. There's a lot of liquidity here. It's shaking out the market. And that is what happens sometimes, right? The question is this accumulation or is this distribution? I guess we'll find out. But what is happening is Bitcoin's making a decision on what side of this it's going to break out of. And that's going to lead the rest of the market with it. And so what do right now? You watch Bitcoin, you buy the lows, you sell the highs, you continue to push through this market. You just wait this bad boy out. You've already waited 6 months. You might as well wait a few more months. It is what it is. You let this puppy play. You trade the range, I think is a good strategy, which is what we've been doing, scooping the lows, taking profits on the highs until something snaps. Eventually, it'll either snap to the upside. We're going to make a fuck ton of profit. And we're going to ride off into the sunset all together, holding hands, being a little bit weird. Or the Bitcoin price is going to come back down. It's going to reset to some of these lower levels, maybe trigger some sort of bear market. And then sure, we have to wait for a year and a half or a year to a year and a half. It is what it is. We'll just get better. We'll get better at trading. We'll get better at technical analysis, fundamental analysis. We'll all be here crying together, drinking our tears, slobbering on keyboards, drinking a beer. What can you do? But it's not this big deal. Stop freaking out, especially again about the idea that people are freaking out because Bitcoin's pulling back right now. You're just being a crybaby. Simple as that. Okay. So that's kind of the macro analysis. That's kind of the broad overview of what's happening in the crypto market. And if you enjoyed this little segment for the last 30 minutes, I just yapped and ranted on exactly what's happening here in the market and exactly what you should be paying attention to, drop a 1 in the chat. I want to make sure you guys find this sort of thing interesting. Okay. But all in all, that's where we are. Now, listen, we are going to see the Fed release their interest rate cut decision in a second. In about 2 minutes here. So we're just going to kind of wait and see how this bad boy goes. Now, before we do go ahead and see that, while we're waiting on it, and I see all the ones, shout out to you guys. But while we're waiting on this interest rate cut decision, I do want to let you guys know, I've showed you a couple times now what we're doing over in the Discord. You can see what I'm buying, what I'm selling. I just dropped some alpha on them. I'm not going to tell you what I told them. I ain't saying it because I want to keep some stuff private for the school, but I dropped a little bit of alpha. You can see the reactions. They like the alpha. I showed them all types of stuff. This is a stock market portfolio I've been working on, right? Trying to make 50 grand off this portfolio, whatever. All this stuff. If you want to see what I'm doing, what I'm buying, what I'm thinking, all this stuff, if you want to get coaching lessons, live streams, workshops, daily analysis, and realistically, if you just want to join a community of people who are winning, simple as that. If you want to join a community of people who are winning here in crypto, check out the link to the crypto school down below. I mean, 1,000% gain, crazy, 300%, 200%, 28%, 91%, 100%, 179%. Do I need to keep going? This is just in the last 20 hours, right? Look at the gains, right? And so if you want to check it out, one thing I will let you know is one person, only one of you, there's 900 people on this live stream right now. One person who goes to the link down below, click start learning today, you're going to get taken to the checkout page. As you can see here, yes, it is $99 or $100 every single month. Many people, if you're in the school right now and you think the money that you spend on the school every month is worth it, put a 2 in the chat. Show the people what you think. One person who goes in here and types in this code, OCT29, you're going to get 20% off. So feel free to go use it. There's 900 people in here. That's probably going to be gone in the next 2 minutes. So check out the link down below. Let me know if you guys have any questions. Okay. And again, 2, 2, 2, 2, 2. I mean, it speaks for itself, right? So feel free to check it out if you want. I'll leave that there. But all in all, we do, I believe, let's see. I do believe we are about to get the decision here. So let's go ahead and go look for it. Hopefully my times aren't off. I do believe it's 1 p.m. my time, 2 p.m. Eastern. So let's go ahead and take a look. Let's see. Here we go. All righty. Here we go. So, oh, by the way, if you're in here like this, okay. So let's see. Okay, cool. So this is what the Fed just stated. And I'm going to change the title now that. One second. Live FOMC meeting. All right, here we go. Boom. So let's go into it then. So, available indicators suggest that economic activity has been expanding at a moderate pace. Job gains have slowed this year, and the unemployment rate has edged up but remained low through August. More recent indicators are consistent with these developments. Inflation has moved up since earlier in the year and remains somewhat elevated. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the long run. Uncertainty about the economic outlook remains elevated. Okay, good to know. I'm going to leave that. The committee is attentive to the risks to both sides of its dual mandate and judges that downside risk to employment rose in recent months. In support of its goals and in light of the shift in the balance of risk, the committee decided to lower the target range for the federal funds by one fourth percentage point to 3.34 to 4%. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, evolving outlook, blah, 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 blah. The committee decided to conclude the reduction of its aggregate securities holdings on December 1st. The committee is strongly committed to supporting maximum employment and returning inflation to 2% objective. In assessing the appropriate stance of monetary policy, the committee will continue to monitor the implications of incoming information for the economic outlook. The committee will be prepared to adjust the stance of monetary policy as appropriate if risks emerge. Hold on, I stopped paying attention. My bad, y'all. The committee will be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the blah 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 blah. Okay, cool. So what just happened? Well, the Fed just decided that they would cut interest rates by 25 basis points. It's what everyone expected. There was basically a wait 1 second. Stream offline. Let me know if the stream's good. What are y'all talking about? Are we good? Hold on 1 second. No, we're good. What are y'all talking about? We're good. All good. All good. All good. All good. That was weird. Anyway, some people were saying the stream was up. Maybe I got trolled. Anyway, okay, so 25 basis points. Everyone expected that a 25 basis point cut was happening. I think Poly Markets was literally at like 99% chance that that was going to happen. Exactly what the market expected. Now, I'm actually a firm believer that when things like this happen, it's a good thing, right? I don't want the Fed to come out and do any spicy shit that no one expected. I'm honestly not in the mood for them to cut it by more than they were supposed to. Don't come out and not cut it. That would literally just kill the market. Just do what you're supposed to do, right? And the reason why I say that this is good news is because remember, the market is very fragile right now, one. And so anything that happens that is unexpected is going to cause chaos. But two, I don't need to give these market manipulators one thing that they can use it as a disguise. Because I'm under the belief that when we see these big events happen, these unexpected things that trigger emotions, that's the second that these market manipulators do their fuckery, right? And so I think there is a clear confluence between Trump saying he's going to put 100% tariff on China and the market manipulators executing on the biggest liquidation event in history, right? It's disguises. These sorts of emotional periods are disguises. And this avoids that, right? Because since they've come out and done exactly what they were supposed to, it avoids any sort of big disguise that they can use to really manipulate the market. And so I don't expect that we're going to see anything super crazy happen. I think it's very reasonable to assume that Bitcoin's price might trickle down a little bit, maybe continue to liquidate some of these traders, but over the mid to long term, I still am expecting some gains. I'm expecting this market to move in the direction that it's of upwards, and because that's where there's a lot of pain at in this market, right? So many people have been liquidated. So many people have lost. So many people are betting that the market is going to go down. And so many people have cooled out of crypto that going up is actually a net positive, right? Like there's a lot of pain. How do I explain this? There's a lot of the market will generally move in the direction in which the most pain will occur, right? For the retail investor. And oftentimes this is due to the fact that market manipulators generally benefit from the losses of retail. So when retail is emotional, when they're pissed off, when they quit, when they're sad, when they give up, when they get liquidated, whatever, that is oftentimes best for these market manipulators, right? These market movers. And if Bitcoin's price and crypto prices over the long term were to go up, think about how many people have been liquidated recently. They're going to be fucking pissed because they were betting it was going to go up and they were right, but they just had so much leverage that they left themselves exposed and they lost, right? So they're going to be revenge trading. They're going to be mad. Think about how many people are short trading. Think about these low ass prices that these market manipulators have been recently able to accumulate, like Ada Cardano at, for example. I think all of the incentive in the world is for this market to move upwards over the mid to long term. So I just don't see a reason as to why it won't. Right. And sure, I may be wrong. And I've said this consistently time and time again. Sure, I may be wrong. And if that is the case, it is the case. I just don't see why I am. I've started to get into a position which I feel like I can think like these motherfuckers, honestly. Like, for example, whenever Bitcoin's price was falling to 103K and everybody was calling for the bear market. I told you all, I was like, I don't see a world in which they allow these people who are betting that it's going to go down to win. I can't imagine that they're going to let them win. They'll let them win a little bit to make them feel good, but then they're going to smash them. And next thing you know, Bitcoin rallies back up towards 116K, right? And so you have to kind of think about it from the perspective of these lizard people. And you have to think what would benefit them the most. And in my opinion, short-term volatility, short-term chaos, shaking out this market, ripping through the liquidations to the upside, to the downside, until you see open interest fall, and then pushing the market upwards would be of the best benefit to them. In the short to mid slash long term. In the really long term, truth be told, in the really long term, to counter that argument, what would also benefit them, give me 1 second, guys. I feel like the live stream's like breaking. I don't know what's going on there. That's odd. It's almost like everything just froze up. Yeah, it's weird. I don't know. I don't know what keeps going on with the stream. My bad, y'all. But yeah, so in the super long term, what could benefit these lizard people, right, is a bear market, right? There would be a lot of benefit from the market pulling back, Bitcoin price falling back to say 60, 70K, altcoins really heavily falling. And the reason why I think that there could be a benefit from that for these market manipulators is because they can accumulate at lower prices, but they've shown that they can pull this market down. They've shown that in an instant they can pull this market down and really accumulate. I mean, look at the prices that they accumulated: SWI, ADA, Solana, XRP, all these fucking cryptos. Like, just what, October 9th was that crash, or 10th, something like that, when the market fell. They were able to accumulate. These were algorithmic purchases. I couldn't purchase at that bottom. You couldn't purchase at that bottom. Someone purchased at those bottoms because the price immediately rallied almost algorithmically across all of those things. Stop orders weren't firing off. Buy orders weren't firing off. Nothing was happening. Retail couldn't do anything. So they've shown that they can pull this market down and accumulate at lower prices without needing these markets to really heavily fall for 12 months or an extended period of time, like in a bear market. So I don't think it's likely that they take that route. I think it's more likely that events like we saw on the 9th or 10th happen again every now and then and give them the opportunity to accumulate from a macro perspective. I think that's what's more likely here. Okay. And so that's kind of just the game that I'm playing here. And that's what I believe is going to happen. And so only time will tell. But one way or another, I'm not that concerned. And I think that what we just saw with the Fed coming out and doing what they're supposed to do is a good thing. Now, how does this impact crypto? How does the Fed continuing to cut interest rates impact crypto? Well, again, it adds to my thesis, right? Because even though the Fed cutting interest rates right now should for no reason push Bitcoin up to 150K, it wouldn't make sense, right? Just because they're cutting interest rates right now does not mean that there's any active impact on the market quite yet, right? This takes 6 months. This takes 8 months. This takes 10 months. It takes time for interest rate cuts. And overall, the ending of quantitative tightening prior to quantitative easing, it takes time for these things to develop and actually have an impact on the market. No one truly knows to what capacity this is going to impact the market, but it should in some way, right? So I do think that it is going to be beneficial, but it's not like a right now thing. It's like a later on thing. And so because of all of these things, the way that I look at this and the way that I see it is like, yeah, we're in a good spot. The crypto market's in a good spot. Altcoins are in a good spot. And although you may not feel that is the truth, it is the truth. Get over it. Right. I know some altcoins haven't performed well and some altcoins haven't seen many gains, but that is the natural order flow of this market. It's what happens. Bitcoin pumps, top 10s pump, macros pump, stability does good. And then over time, when crypto gets confident, when retail gets confident, when they feel that money coming in, they feel that willingness to take a bit of a risk, you're going to see that money trickle down and flow into your altcoins. It's just the way that it goes. It's the reason why Bitcoin pumped, and now Ethereum and Solana and XRP are all very close, and BNB are all very close to altcoins. And I don't know how I'm the only one who sees this. I feel like I'm the only one who sees what's happening in this market because that is what happened. Bitcoin's price pumped all-time high, right? This year, all-time high. Look at this. Hold on, just in case you forgot for some reason. All-time high. Then what happened? Solana's price pumped. Where? Very, very close to an all-time high. Then XRP's price did what? Pumped very close. Or no, up to $3.60. Guess what? ATH. Then what happened? What else is in the top 5? BNB. Where's that at? All-time highs. Where's Ethereum's price at? Not all-time highs, but getting close to what? All-time highs. Extremely close to these all-time highs. So what is happening right now? Bitcoin first, then the top alts next, and then what? It's the same flow. It's the same way this happens every single time. People are just impatient and they're being crybabies. Simple as that. And so you got to stop crying and you got to look at this objectively. The market is moving exactly how it's always moved. It's doing exactly what it always does. Now, does this mean that we're going to see an altcoin season the same size as the ones that we always see? Of course not. How could we? I don't think that we will. Why? Because we're not going to see people just being given money like they were in 2021. Enough people have lost in crypto now to understand that some coins just fucking suck and it is what it is. There are more coins in circulation right now. Most cryptos are not very unique, so most cryptos aren't going to do well, in my opinion. And more people who are betting on altcoins as their risk play previously are using their risk play from leverage. Like the same people who were aping into altcoins in 2021, they've switched their ideas and they've started now leverage trading, which is why you're seeing leverage so much bigger. And so naturally, a lot of the liquidity that altcoins saw in spot purchases has now been shifted over to leverage trades because people are trying to get rich faster. And so naturally, that is going to stop some sort of altcoin season similar to 2021. No, I don't believe we're going to see a parabolic run in which every single crypto in the top 1,000 goes up by a 10x or 20x. That's unrealistic. That's just not going to happen, in my opinion. But what I think will happen is that liquidity will flow from the top cryptos down to the smaller cryptos, to the smaller ones, and specific and select cryptos amongst all of these niches will perform extremely well. And you're going to see cryptos give you 10x, 15x, 20x, 100x. You're going to see that happen. It's just not going to be every single crypto in circulation right now because it's unrealistic. It's just not going. It's not fucking tangible. There are too many cryptos for them all to explode like that without crypto being $100 trillion in size. It's just impossible. And so stop looking at it from that perspective. Peel yourself back. Stop trying to get rich fast and look at this objectively and think, you know what? Bitcoin, Solana, XRP, Ethereum, BNB. Oh, we are trickling down a little bit. Institutional interest is becoming a little bit more risk on, and that is naturally going to provide liquidity to some altcoins to give us some growth. So look for high quality, good crypto projects that have a fucking solution to a problem that generate revenue. And if they make money, they do good marketing, they build a good community, and they have a good use case, they're probably going to give you good gains. You just need to be patient. Got it? Great. Simple as that. It's not even complicated, okay? And if what I just said makes sense, all I want you to do is put a 3 in the chat, just so I understand you guys are following me here, okay? And so with that in mind, we're going to get the FOMC meeting in about 17 minutes. So I want to open up the chat for some questions. So all I want for you to do is just go in, drop some questions in the chat, and we'll answer questions for the next 13 minutes, okay? And I feel as if some people aren't able to chat, and I don't know why. Oh, you know what? Oh, hold on. Okay. I think that should fix it. So for some reason, YouTube set my video as made for kids. And so I think it messed the chat up, but I think the chat should be fixed now. I think y'all should be back. I don't know why that happened. Yeah. There we go. Okay. All right, we're back. What up, boys? Welcome back. Yeah, so when I changed the title, it must have set it to made for kids for some reason. What's up, everyone? Welcome back. My bad. Okay. All right. Okay. I was wondering where y'all went. Look, I'm not an egotistical guy. I am. I'm a little bit egotistical. I'm not gonna lie to you. But the chat was mass low, and I was like, damn, bro, am I not spitting facts? Like, I feel like I'm spitting facts right now. And it seemed like nobody agreed. So I was like, what the fuck? Anyway, welcome back. Hey, if you agree with the rant I just went on, drop a 3 in the chat, okay? Per your logic, there won't be a meme season. Memes have no utility. I don't think there will be a meme season the same size as what we've seen before. I think some memes will do great because remember what I said. You have to have a certain mixture of things, marketing, community, etc., right? So, yeah. Okay. All right, you agree. Y'all all agree. I'm about to say, bro. I was like, bro, am I not spitting facts right now? Okay. Welcome back, everyone. Welcome back. Yeah, that makes sense. Cool. All right, shout out to Navdeep Singh Bajaj. Hopefully I got that one right. Your ETH prediction by December, please, just rough guesses. I'll give you a rough guess, but I genuinely don't know. I hope you understand. I actually have no idea. Let me give you two scenarios. By December, if each price is capable of breaking through this red zone, I think pushing back up past this all-time high and giving us some sort of run towards $5,500 is reasonable. That would be hard, but reasonable. Okay. Shout out to you, V Hunt. I try my best, G. Does it say a lot about Dogecoin being a top 10 crypto and somewhat underperform? What do you mean? All right, go ahead and ask your questions, guys. Go ahead and ask your questions. We got 14 minutes until Jerome Powell goes out and speaks. So let's go ahead and let's drop some questions. Also, guys, while you are asking your questions, I got some shilling to do really quickly. So give me a second. Ask your questions and I'm going to shill. First and foremost, if you are doing some trading, first of all, if you've never leverage traded before, don't start now. Now is not the time. But if you know what you're doing and you're actually good at leverage trading, I do have a link to BTCC down below. You can get up to $10,000 in bonuses if you sign up specifically with my link. That's on anything up to over $500. You're going to get a deposit bonus that could be up to 10 grand in bonuses. And you're going to get low trading fees compared to many other platforms. So check out that link down below. Again, only if you are experienced. For God's sake, do not leverage trade if you don't know what you're doing. Also, guys, as I mentioned before, one of you who uses this code when you sign up today is going to get it. I think someone already got it, so maybe wait until tomorrow. I do have an Instagram page where I do, and again, ask your questions in the chat down below. I'm about to do a Q&A. I do have an Instagram page. It's The Life of Tyler Hill. It's linked down below. I post extra content about what's going on in the market with the whales, all that stuff, and also personal stuff. You can see kind of what I'm doing, what I've been up to, some fighting career stuff, blah, blah, blah. And then last but not least, I do have a second YouTube channel, which is linked down below. It's called Tyler Teaches Crypto, where you guys can get extra information. I do post one video on here every single week where I go over systems, strategy, basic stuff, educational stuff like that. So feel free to go check out all those links. They are linked in the description down below. But without further ado, let's answer some questions, shall we? Okay, does BTCC futures work in EU Finland? I am not sure. Do you think the market manipulators are going to drive the price down further after the dump? They could. Yeah, I mean, they could. I don't know what they're going to do, but I do believe one way or another, even if they do, it's just temporary. Short-term analysis on Solana. Yep, I did that earlier, but I can do it again really quickly. Just pay attention to the descending channel. I'm buying in the green zone, selling in the red zone over and over and over again until something happens. Right now, I feel the FOMC meeting or the FOMC and the quantitative tightening ending in December aren't pricing as much as the first round of rate cuts happened. I would agree with you on that, mostly because people just don't know what's going to happen. Guys, I also feel like my damn setup looks. Oh, there we go. There we go. I feel like that's more normal. I don't know, but check out the link down below. You should know whenever you click it. You talking about a crypto name Primed? I think grid trading is solid. I've never really gotten into it enough to actually have a genuine understanding of it or a genuine like opinion about it. But I do think it is good in general, especially during volatile periods. Yeah. Thoughts on Bitcoin dominance? Where do you think it will end up in Q4? I'm not 1,000,000% sure yet. Still pretty elevated, though, I'd say. What the hell was my kid watching? I was ranting to your child about crypto. Could you please look at the technicals for XPL Plasma, please? Thank you. Really quickly. Really quickly. We don't have a ton of time before the meeting starts. These don't look great. I'm not gonna lie to you. There is some sort of bullish divergence forming here, right? What you can see is that XPL is giving you these ascending lows with these descending lows here. That could be a sign that this thing is losing momentum to the downside and could enter into some more of like it may be in some sort of accumulation period right now. So it could be decent, but I wouldn't really. I don't chase charts like this personally. Are you the market manipulator? If I was, I'd tell you, or I wouldn't. Your price target on Solana by 2025? Not sure. I don't give price targets, guys. Like, I don't really give price predictions all that often because I think they're nonsense. I don't know what's going to happen with Trump. I don't know what's going to happen with the Fed. I don't know what's going to happen with so many different things. The market manipulators, there's so much that's going to happen. It's impossible to really know. I just follow the price action and make determinations based on that. But when I look at A to the game is simple. It's trying to find some support on the yellow zone, and it needs to use that support to get back above the blue line. Once it gets back above the blue line, it can open up for some really strong gains. But while it's below the blue line, all of its gains will be limited and very, very risky. Let's see. Iron Dragon. I don't think Solana will hit the green zone this time. It may not. It may not. That is very possible. What's a bigger deal, today's meeting or the China trade talk tomorrow? China for sure. China. How do you find small altcoins to invest in? Usually just typically a lot of the ones that I find come through my company Fluence. Like I'll see them starting to spend a lot of money on marketing, and I know what happens after that. Yeah, the rate cut is official. I've heard a lot about Linnea recently. Do you think the market will move much today after Powell BS either way? No, unless he says something really dramatic. Would you ever make a detailed video on how you leverage trade? Things like strategies, good times to use this type of trading, and so on. Yeah, definitely. I'm not a huge trader these days. I don't trade very often, but one thing I will let you know is some of the best traders in the world are in our school, and the results speak for that. So even if I don't, there are still a lot of options that you can learn from in there. What are your thoughts on an extended bull market? Very, very possible. Did you hear Western Union shown solo over XRP? It makes sense. It just makes sense to me. Like, especially considering the fact that Solana recently has held up so well. It makes a lot of sense to me. I don't see why not. When are you going to do a live stream with Connor? Yeah, we got to do one. Connor's in a completely different time zone than me right now. We're like opposite time, so it's just difficult. I have not heard of XCL, but it sounds cool. You think $205 Solana is possible in short term? Yeah, if the market moves in that direction, of course. FOMC meeting in 8 minutes. All right. Well, look at AVAX. My word. Okay. Well, that's obvious. Okay, so that's obvious to the top side. That's super obvious to the down. I mean, yeah, like I don't really need to say too much. AVAX is in a macro trend right now. It's been in a macro trend for quite some time, and AVAX is going to have to make a decision at some point. Like, is this a crypto that's here to stay or not? The thing that AVAX struggles with the most is it's not very unique almost at all, and so it doesn't really get a lot of attention anymore. But I will say that if AVAX can clearly break above this blue line, that would be a very big sign. Like, hey, AVAX is going to try to make another run for it, and maybe even push it back to like $60 or $70 or something like that. So yeah, I think AVAX from a technical perspective easily could make that move. It's just going to need the volume to support it, which is going to be difficult because it's just not very unique anymore, to be honest. When you say some coins will do well, and what percentage of X are we talking about? Yeah, about 3 or 4. Yeah, I still like Coral Protocol. All those crypt guys, I'm a long-term ass buyer, bro. So when I buy something like Coral Protocol, TARS AI, all that, I still have them. I still hold them. Is it a realistic plan on using crypto as leverage for a house down payment next year, or just sell profit and pay taxes that way? What do you mean as leverage? It depends on, there's so much that goes in that. How much income do you make? What size house are you trying to get? How big is your portfolio, etc.? Quantitative tightening is ending. Quantitative easing is not happening quite yet. Bro, you inspire me to start YouTube. Alex, Ray, shoot me an email. My company, Fluence, we have a program where we can help you do that. We have guys in our program who literally make like 8,000 to 10 grand every month from being a YouTuber. It's actually insane. So shoot me an email to my email. It's in the description down below, and say, want to speak about becoming a YouTuber, and I'll respond to you there. What keywords to look out for in the meeting to be bullish or bearish? I think it's more of a tone than anything. I'm just expecting him to be cautious. That's all I want from him. I want him to come out and basically just be like, "Hey, we're gonna keep gathering data. We're still gonna check the data, and then we're gonna go and make our decisions based on what the data says and what the data does. And we have a dual mandate and blah blah blah. All the basic shit. We just want him to be neutral. That's all we want. Anything in either direction could start to freak the market out. Top alts doing a 5x will be hard, but possible, yeah. No. Don't join the school trying to follow crypto signals and buy and sell stuff and make a whole bunch of money. That's not the goal. Crypto is not about getting rich quick. Crypto is not about getting rich fast. Crypto is about building wealth over the long term. And we teach you the tools and the strategies you need to be able to do that. So no, you're not going to make your money back in 30 days. You might not make it back in 1,000,000 days. You might not make it back ever, but you will have the tools that you need to find long-term success. So if you want long-term success, join the school. If you want to get rich fast and short term and copy, buy, sell signals without actually learning anything, the school is not the place for you. Please do not join. Cade, your kid's going to be rich. Shout out to you, Juan. I'll try my best, homie. All right, how long we got? 4 minutes. I'm going to get this bad boy started up. It's never a bad idea to rotate up. You just have to understand that you're de-risking when you do that. Okay. All right, let's get ready for the meeting. Okay. Give me 1 second, guys. There we are. Okay. No, Brick. I'm not going to blow my nose. Leave me alone. Do we have to sell our alt portfolio getting into the bear market? Can we see any moves for? I mean, I personally rotate decently, like a good bit up into Bitcoin and like the top 3, and then I'll rotate back into alts at like the beginning of bull markets, or like once we're in some sort of accumulation phase. I don't know. Yeah. I mean, that's pretty frequent. They are usually late, aren't they? Literally, bro. I don't know. Why'd you open it? Bitcoin dominance, in my opinion, for us to like be in an altcoin season, Bitcoin dominance would need to be like falling below 54%, I would say. How big of a negative impact do you think pump fund era? What the fuck was that? What was that? Was that a crane? Did y'all see that on the screen? How big of a negative impact do you think pump fund era has caused to crypto? Not that much. I don't think it definitely slowed things down last year, but it's not still slowing things down now. That much. Fucking UFO just went across the screen. Yeah, I do. What? Leo is a construction worker. 10 years, Bitcoin will probably hit like $500,000 within the next 10 years, I'd say. All right, let's rock and roll, boys. Say your prayers, G. He got that drip on today.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although some important federal government data have been delayed due to the shutdown, the public and private sector data that have remained available suggests that the outlook for employment and inflation has not changed much since our meeting in September. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals and in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by a 1/4 percentage point. We also decided to conclude the reduction of our aggregate securities holdings as of December 1. I will have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a moderate pace. GDP rose at a 1.6% pace in the first half of the year, down from 2.4% last year. Data available prior to the shutdown show that growth in economic activity may be on a somewhat firmer trajectory than expected, primarily reflecting stronger consumer spending. Business investment in equipment and intangibles has continued to expand, while activity in the housing sector remains weak. The shutdown of the federal government will weigh on economic activity while it persists, but these effects should reverse after the shutdown ends. In the labor market, the unemployment rate remained relatively low through August. Job gains have slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Although official employment data for September are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index suggest that total PCE prices rose 2.8% over the 12 months ending in September, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8% as well. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or two or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 3.75% to 4%. Higher tariffs are pushing up prices in some categories of goods, resulting in higher overall inflation. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. With downside risks to employment having increased in recent months, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. We continue to face two-sided risks. In the committee's discussions at this meeting, there were strongly differing views about how to proceed in December. A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it. Policy is not on a preset course. At today's meeting, the committee also decided to conclude the reduction of our aggregate securities holdings as of December 1. Our long-stated plan has been to stop balance sheet runoff when reserves are somewhat above the level we judge consistent with ample reserve conditions. Signs have clearly emerged that we have reached that standard. In money markets, repo rates have moved up relative to our administered rates, and we have seen more notable pressures on selected dates, along with more use of our standing repo facility. In addition, the effective federal funds rate has begun to move up relative to the rate of interest on reserve balances. These developments are what we expected to see as the size of our balance sheet declined and warrant today's decision to cease runoff. Over the 3.5 years that we've been shrinking our balance sheet, our securities holdings have declined by $2.2 trillion. As a share of nominal GDP, our balance sheet has fallen from 35% to about 21%. In December, we'll enter the next phase of our normalization plans by holding the size of our balance sheet steady for a time, while reserve balances continue to move gradually lower as other non-reserve liabilities, such as currency, keep growing. We will continue to allow agency securities to run off our balance sheet, and will reinvest the proceeds from those securities in Treasury bills, furthering progress toward a portfolio consisting primarily of Treasury securities. This reinvestment strategy will also help move the weighted average maturity of our portfolio closer to that of the outstanding stock of Treasury securities, thus furthering the normalization of the composition of our balance sheet. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting our maximum employment, bringing our inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, are you uncomfortable with how market pricing has assumed a rate cut is a foregone conclusion at your next meeting?
Well, as I just mentioned, a further reduction in the policy rate at the December meeting is not a foregone conclusion, as I've just said. So I would say that that needs to be taken on board. We had, just say this, 19 participants on the committee. Everyone works very hard at this and takes their obligations to serve the American people very seriously. And at a time when we have tension between our two goals, we have, strong views across the committee. And as I mentioned, there were strongly differing views today. And the takeaway from that is that we haven't made a decision about December. And, we're going to be looking at the data that we have, how that affects the outlook and the balance of risks. And I'll just say that.
You and some of your colleagues have framed last month and maybe today, I won't put words in your mouth, there's a risk management exercise. At what point do you conclude that you've taken out enough insurance? Are you looking for some kind of improvement in the outlook, or could this unfold along the lines of last year, where you made a sequence of adjustments and then waited to gather more information?
So the way I've been thinking about it is the risks to the two goals. For a very long time, the risk was clearly of higher inflation. And then that has changed now. And as we saw particularly after the July meeting, we saw the downward revisions in job creation, we saw a very different picture of the labor market, and suggested that there were higher downside risks to the labor market than we had thought. And that suggested that policy, which we had been holding at a I would say modestly, other people would say moderately restrictive level, needed to move more in the direction over time of neutral. If the two goals are sort of equally at risk, then you ought to be at neutral, because one of them's calling for you to hike and one of them's calling for you to cut. So if that got back into balance, then you'd want to be roughly at neutral. So in that sense, it was a risk management. And I would say the same about today, sort of the same logic. But as I mentioned, going forward is a different thing.
Claire.
I'm Claire Jones, Financial Times. Thank you for taking this question. We've just heard from you that the discussion in December and the conclusion of the discussion is not a foregone conclusion. I'd like to just dig into that a little bit more about what sort of arguments were brought up. Was there any consideration, for instance, of the investment we're seeing in AI and some of the generation of household wealth through rises in stock prices related to the AI boom? Thank you.
You know, I wouldn't say that's a factor in everyone's assessment of the economy. I wouldn't say it's the driving factor. I don't think for anybody. You know, I guess I would say it this way. Once again, I would just point out that we have the situation where the risks are to the upside for inflation and to the downside for employment. We have one tool. It can't do both of those. You can't address both of those at once. You've got a very different situation. So you have some people have different forecasts, right? So they'll forecast faster or slower progress on one or the other. And they also have different levels of risk aversion. And, you know, some will be more averse to inflation overruns, and some will be more averse to underruns of employment. And so you put that together, and as you can see from the SEP and from the public discussion that goes on between the meetings when participants go out and talk, they're very disparate views. And they were reflected in strongly differing views in today's meeting, as I pointed out in my remarks. And that's what leads me to say that, you know, that we haven't made a decision about December. You know, I always say that. It's a fact that we don't make decisions in advance. But I'm saying something in addition here, is that it's not to be seen as a foregone conclusion. In fact, far from it.
Can I just ask a quick follow-up on QT? How much of the fund impressions we've seen in money markets are related to the U.S. Treasury issuing more short-term debt?
You know, that could be one of the factors, but the reality is we've seen, you know, the things that we've seen, higher repo rates and federal funds rate moving up. These are the very things that we look for. We actually have a framework for looking at, you know, what the place we're trying to reach. What we said for a long time now is that when we feel like we're a bit above what we consider a level that's ample, that we would freeze the size of the balance sheet. Of course, reserves will continue to decline from that point forward as non-reserve liabilities grow. So this happened, some things have been happening for some time now, showing a gradual tightening in money market conditions. Really in the last, call it 3 weeks or so, you've seen more significant tightening, and I think a clear assessment that we're at that place. The other thing is, you know, the balance sheet is shrinking at a very, very slow pace now. We've reduced it by half twice, and so there's not a lot of benefit to be holding on to get the last few dollars because, you know, again, the balance sheets, the reserves are going to continue to shrink as non-reserves grow. So, you know, there was support on the committee as we thought about it to go ahead with this and announce effective December 1 that we will be, you know, freezing the size of the balance sheet. And the December 1 date gives the markets a little bit of time to adapt.
Colby. Thank you. Colby Smith with the New York Times. So much of the rationale for cutting interest rates, even as inflation moves away from the 2% target, seems to be, you know, that there are these mounting downside risks to the labor market. But if those don't materialize and the labor market either stabilizes around current employment levels or even starts to strengthen somewhat, how would that change your perception of how much interest rates need to fall from here? Would you then be a bit more concerned about underlying inflation and the possibility of second-round effects from tariffs?
Yeah, I mean, in principle, if you were to see data that suggested that the labor market's strengthening or even that it's stabilizing, you know, that would certainly play into our decisions going forward. So, we do have, you know, we get some data. The labor market is a place where we get, for example, we get the state-level data on initial claims, which are sending a sort of a signal of more of the same. We also get, you know, job openings, and we'll get lots of survey data. We'll get the Beige Book and things like that. So we'll have a picture of what's going on in the labor market, and you know the fact that we're not seeing an uptick in claims or a downtick really in openings suggests that you're seeing maybe continued very gradual cooling, but nothing more than that. So that does give you some comfort.
But if this shutdown lasts a while longer and you don't have that data in hand, I'm just wondering how that hinders the committee's ability to assess the state of the labor market and make the right policy decisions, and also how much is that factoring into the debate about December? Yeah.
So, you know, we get like I mentioned what we get in the labor area. We get some data in inflation, some data in economic activity. And we'll have a picture of what's going on. We also will have the Beige Book again. I would say we're not going to be able to have the, the detailed feel of things. But I think if there were a significant or material change in the economy one way or another, I think we'd pick that up through this. So in terms of how it might affect December, it's really hard to say. December's, the meeting's, I guess, 6 weeks away. We just don't know what we're going to get. If there is a very high level of uncertainty, then, that could be an argument in favor of caution about moving. But we'll have to see how it unfolds.
Steve.
Steve Leisman, CNBC. Mr. Chairman, can you characterize the meeting in terms of, you said strongly differing views. Was this a close call, this cut, or was it a close call maybe the other way because you had dissents on both sides? Thanks.
So I was referring to the discussion about, to the extent it related to December. You saw we had two dissents, one for 50 and one for no cut. So, that was a strong, solid vote in favor of this cut. The strongly differing views were really about the future. What does that look like? And I think people are saying, they're noticing stronger economic activity. Forecasters generally, broadly, have raised their economic growth forecasts for this year and next year, in some cases quite materially. In the meantime, we see, a labor market that's kind of, I don't want to say stable, but it's not clearly in motion. It's not clearly declining quickly in any case. It may be just continuing to gradually cool. And again, people have different forecasts and expectations about the economy and different risk tolerances. And so there's you read the SEP, you read the speeches, there are differing views on the committee, and to the point where I said what I said.
And just to follow up on the balance sheet, if you stop it, the runoff now, does that mean you have to go back to actually adding assets sometime next year so that the balance sheet doesn't shrink as a percent of GDP and become a tightening factor?
So you're right. The place we'll be on December 1 is that the size of the balance sheet is frozen. And as mortgage-backed securities mature, we'll reinvest those in Treasury bills, which will foster both a more Treasury balance sheet and also a shorter duration. So that's what. In the meantime, if you freeze the size of the balance sheet, the non-reserve liabilities, currency, for example, they're going to continue to grow organically. And because the size of the balance sheet is frozen, you have further shrinkage in reserves. And reserves is the thing that we're managing that has to be ample. So that'll happen for a time, but not a tremendously long time. We don't know exactly how long. But at a certain point, you'll want to start reserves to start gradually growing to keep up with the size of the banking system and the size of the economy. So we'll be adding reserves at a certain point, and that's the last point. Even then, we didn't make decisions about this today, but we did talk today about the composition of the balance sheet, and there's a desire that the balance sheet be right now it's got a lot more duration than the outstanding universe of Treasury securities. And we want to move to a place where we're closer to that duration. That'll take some time. We haven't made a decision about the ultimate endpoint, but we all agree that we want to move more in the direction of a balance sheet that more closely reflects the outstanding treasuries, and that means a shorter duration balance sheet. Now, this is something that's going to take a long time and move very, very gradually. I don't think you'll notice it in market conditions, but that's the direction of things.
Janelle.
Janelle Marte with Bloomberg. How are officials interpreting the latest CPI report? So some components came in lower than expected, but core inflation was still at 3%. So at this moment, what are you learning about the drivers? And also, do you view that the risks are greater that the Fed makes a mistake on employment or inflation?
So the September CPI report, we didn't get PPI after that, which is important for translation into what we look at, which is PCE inflation. But we can still make a pretty good assessment of what that will be. When we get PPI, there might be some adjustments. But so directionally, it was a little softer than expected, and we always break it down into the three components. So basically, you've seen goods prices increasing, and that's really due to tariffs. And that's compared to a longer run trend of very, very mild deflation in goods. So that's moving inflation up. On the other side of that, good news, that housing services inflation has been coming down and is expected to continue to come down. So if you remember a couple of years ago, that's the one that we kept expecting it to do that. Now it's been doing that for some time, and we expect to continue that. That leaves the biggest category is services other than housing services. And that's kind of been moving sideways over the last few months, but a significant part of that is non-market services. And we don't take a lot of signal about the tightness of the economy from that. So if you add all that up, a couple things to say. One is that inflation away from tariffs is actually not so far from our 2% goal. We estimate, people have different estimates of what that is, but it might be, 5 or 6 tenths. And so that, if it's 2.8, then core PCE, not including tariffs, might be 2.3 or 2.4 in that range, something like that. So that's not so far from your goal. So that we look at that, and the thing about tariff inflation is the base case is that it will come and it probably will increase further, but it is that it will be a one-time increase. And we've been very focused for all of this year at making sure that that's the case and thinking carefully about what are the pathways through which it could become something else, troublesome inflation. One of those would be, a really tight labor market. We don't see that. Another could be inflation expectations moving. We don't see that. So I think, we're watching this very carefully. I think it's not the case that we're just assuming that it's going to be a one-time inflation. We understand fully that this is a risk we have to monitor and ultimately manage.
With the stubborn in services inflation, what are some of the things that the Fed could do to address that, and especially when we're seeing potentially labor supply challenges?
Sorry, say the first.
The stubborn services inflation that you mentioned.
Services inflation, yeah. Well, again, the part of services inflation that isn't coming down as we would like it to is the non-market part of non-housing services. And overall, that's just something that we expect will come down. The non-market part of it should come down. It largely reflects higher stock prices and financial services that are imputed rather than actually paid is a big part of that. But also just, we think policy is still modestly restrictive in my telling. So that's the kind of thing that should lead to a gradually cooling economy. That's one of the reasons you see a gradually cooling labor market is because the Fed policy is modestly restrictive. So that should also help get that. I want to say, though, we're absolutely committed to returning inflation to 2%. If you look at longer-term surveys or market pricing, you will see that's a credible commitment, and there should be no question that that's where we're going.
Chris.
Great, thank you. Chris Rugaber at Associated Press. So there's a big investment boom in AI infrastructure right now, as you know, and wondering if the existence of such a boom would indicate that rates are not that restrictive after all, and could further rate cuts at this point perhaps fuel an excess level of investment there or market bubbles? How is the Fed thinking about that?
So I don't think that you're right. There are a lot of data centers being built and other investments being made around the country and around the world. Big U.S. companies are just investing a lot of resources in thinking about how AI, which will be based on those data centers, run through those data centers, is going to affect their businesses. So it's a big deal. I don't think that the spending that happens to build data centers all over the country is especially interest sensitive. It's based on longer run assessments that this is an area where there's going to be a lot of investment and that's going to drive higher productivity and that sorts of things. I don't know how those investments will work out, but I don't think they're particularly interest sensitive compared to some of the other sectors.
And then just a quick follow-up. You mentioned that you do have data that you're looking at for inflation and growth in the absence of government data. Could you give us a sense? I think we know a lot about the jobs data that's out there. Can you give us a sense of what you're looking at to track inflation in the absence of government data? Thank you.
So it's a lot of things, and it doesn't replace government data, but you know all of these. I'll just mention some of the many names: Price Stats, Adobe, and others. For wage inflation, there's ADP data. On spending, you're going to ask about spending at some point. There are lots of other things that we look at, but it's many different sources, and again, including what we get out of the Beige Book, which will be sort of come out mid-cycle as always. And it doesn't replace the government data, but it gives us a picture. Again, I think if something material were happening, if there were material developments, I think we would pick that up. I don't think we'll be able to have the very granular understanding of the economy while this data is not available.
Howard?
Howard Schneider with Reuters. Thank you. I just wanted you to elaborate a little bit on what you said a moment ago about a continued shutdown, making it more difficult to make a move in December, and that may make you more cautious. To the degree you are relying on private data that isn't the gold standard, or that you're relying on your own surveys or the Beige Book, do you worry at some point you're going to have to start making policy by anecdote?
This is a temporary state of affairs, and we're going to do our jobs. We're going to collect every scrap of data we can find, evaluate it, and think carefully about it, and that's our jobs. That's what we're going to do. If you ask me, could it affect the December meeting? I'm not saying it's going to, but yeah, you could imagine that what do you do if you're driving in the fog? You slow down. So that could or could not. I don't know how that's going to play into things. We may get the data may come back, but there's a possibility that it would make sense to be more cautious about moving. I'm not committing to that. I'm just saying it's certainly a possibility that you would say we really can't see, so let's slow down.
As a follow-up in the debate on this meeting, we saw recently some pretty big layoff announcements coming from Amazon and others. Wondering if that figured into the discussion at all, that you're starting to see this tension between growth and employment starting to be resolved, to the detriment of employment. And secondly, some of the stress is starting to appear in the bottom spur of the K, as they call it, household health premiums that are going to possibly be going up quite substantially, things like that. Has that started to become a factor in your policy discussion?
So those are both things that we're watching very, very carefully. To start with the layoffs, you're right. You see a significant number of companies either announcing that they are not going to be doing much hiring or actually doing layoffs, and much of the time they're talking about AI and what it can do. So we're watching that very carefully. And yes, it could absolutely have implications for job creation. We don't really see it in the initial claims data yet. Now, it's not a surprise that we don't. It takes some time for it to get in there, but we're watching that really carefully. But again, don't see it yet in the initial claims data. On the K-shaped economy thing, I would say the same thing or similar thing. We are. If you listen to the earnings calls or the reports of, big public consumer-facing companies, many of them are saying that there's a bifurcated economy there, and that consumers at the lower end are struggling and buying less and shifting to lower-cost products, but that at the top, people are spending at the higher income and wealth, and so much anecdotal data on that, and so we think there's something there.
Edward.
Thank you. Edward Lawrence with Fox Business. So, Mr. Chairman, I want to take another crack at the further reduction of rates is not a foregone conclusion. So in December, you said far from it. So if a cut might not be on the table for December because of lack of data, what does the other concerns then stem from? So if it's not lack of data as the reason December is not a foregone conclusion, what other things could be the concern then? Well,
the perspectives of people on the committee that, we've now moved 150 basis points, and that we're down into, you're into that range between 3 and 4, where many estimates of the neutral rate live in that 3 to 4% area. You're there now. You're above the median number for the committee, but I think there are people on the committee who have higher estimates of the neutral rate, and that's you can argue these positions since it can't be directly observed, the neutral rate. So, I think for some part of the committee, it's time to maybe take a step back and see whether there really are downside risks to the labor market, or see whether, in fact, the growth, the stronger growth that we're seeing is real. Ordinarily, the labor market is a better indicator of the momentum of the economy than the spending data. That's the lore. In this case, that gives a more downbeat read. So people just have, again, we've cut 50 more basis points in the last 2 meetings, and there was a sense like, from some, let's pause here, kind of thing, and a sense from others wanting to go ahead. But that's why I say differing views, strongly differing views.
And so on that division, then you're talking about going forward. So what's more important in this division? Is it inflation risks? Is it employment risk? Or is there a deeper philosophy division among the board?
Look, everybody on the committee is deeply committed to doing the right thing to achieve our goals, maximum employment and stable prices. You have differences on how to do that. And as I mentioned, some of that is different forecasts, but a lot of it is also different risk aversions to the different variables, which is common through all Federal Reserves. People just have different risk tolerances, let's say. So that leads you to people with disparate views. You will know that from the speeches you've been listening to from my colleagues. And so we're at a place now where we have, in fact, cut 2 more times. And, we're 150 basis points closer to neutral, wherever that may be, than we were a year ago. And so there's a growing chorus now of feeling like maybe this is where we should at least wait a cycle, something like that. That's what it is. It's just what you think it would be. It's and again, you've seen it in the September Summer of Economic Projections. You've seen this in the public remarks of FOMC participants, and now I'm telling you that's what you can expect that in the minutes. And I'm just telling you that's what happened in the meeting.
Elizabeth. Thank you so much. Elizabeth Schulze with ABC News. What is your explanation for why the job market is weakening right now, and what will this rate cut do to improve the job market?
So I think there are 2 things affecting the job market, and one of them is just a dramatic reduction in the supply of new workers. And that's 2 things. That's declining labor force participation, which is a cyclical thing. And then there's declining immigration, which is just a big policy change that actually began in the last administration and it has been accelerated now. So a big part of the whole story is that supply side story. Okay. In addition, labor demand has declined, and so the unemployment rate has gone down, meaning that demand for workers is going down a little more than supply. So that's what's going on, but it is mostly a supply function. It's mostly a function of the change in supply, I think, and many people think. So the question then is, what does the our tool do, which supports demand, and I would just say, when you're in a situation where job creation, if you adjust for likely overcounting in the way that BLS does its work, is pretty close to 0. So maximum employment doesn't, on a sustainable basis, if you're creating 0 jobs, if it's in equilibrium, if it's in balance, it's a pretty, as I said before, a pretty curious balance. So, I thought, and many of my colleagues thought, in fact, you've seen the last 2 meetings, that it was appropriate for us to react by supporting demand with our rates. And we've done that. We've reduced so that rates are looser. I wouldn't say that they're accommodative right now, but they're meaningfully less tight than they were. And that should help so that at least the labor market doesn't get worse. Though it's a complicated situation, and some people argue that this is supply and we really can't affect it much with our tools. but others argue, as I do, that there is an effect from demand and that we should use our tools to support the labor market when we see this happening.
You also talked about tariffs causing a one-time price increase. Should American household consumers expect that inflation will continue to go up this year because of those tariffs?
So the basic expectation is that there will be some additional increase in inflation because it takes a while for tariffs to work their way through the production chain and finally get to consumers. And we see this now from the tariffs that were put in place now many months ago. We see those effects, but if you put tariffs in effect, and they've been coming into effect consistently in February, March, April, May, and that's all happening. So that'll continue to happen for some time, probably into the spring. These are not big increases, though. These are a tenth or so on inflation. They may be big increases on a particular product that's been tariffed, but overall, these are fairly modest. I think some projections go, we're at 2.8% inflation. You might get 2 or 3 more tenths or 4 more tenths maybe. But then, as all of the tariffs are in, they stop generating inflation. You've had a one-time price increase. As long as you're not, at least this is the theory, this is how we believe and hope that it will work out. Once the last tariff is put on something, at that point, it becomes a higher price level, but it stops going up, if you will. Prices stop going up. They'll just be at that level. And then measured inflation will come back down to non-tariff inflation. As I mentioned, non-tariff inflation is not so far from 2% now. Now, consumers are not interested in that story. Their prices are higher. More than that, the reason they're so unhappy about inflation is the inflation that we had in 2021, 2, and 3. Because you can say that prices aren't going up as much, but that doesn't mean people aren't feeling those higher prices from the inflation we had 2 or 3 years ago. They are, and that's, I think, a large part of why the public, if you sample people, inflation is still very much making people quite unhappy. Even, and it's nice that, that prices are not going up as fast as they were, but they're still much higher than they were. And it'll take some time for that effect to wear off. As real incomes rise, it will feel better over time, but that's going to take time.
Michael McKee from Bloomberg Television and Radio. Do you have any concerns that equity markets are or are close to being overvalued at this point?
We don't look at any one asset price and say, hey, that's wrong. It's not our job to do that. We look at the overall financial system, and we ask whether it's stable and whether it could withstand shocks, right? So, banks are well capitalized, while some households are clearly under stress. In the aggregate, households are in good shape financially, relatively manageable levels of debt. At the lower income spectrum, you are seeing rising defaults, particularly around subprime auto, but nonetheless, in the aggregate, pretty good. You don't see too much leverage in the banking system or the financial system. It's a mixed picture, but it's not an overly troubling picture. And again, I'm not, it's not appropriate. We don't set asset prices. Markets do that.
Well, you must be well aware that by lowering interest rates, you're contributing to additional asset price increases. And I wonder how you balance the idea that lowering rates would help the labor market with the reality that it seems more likely to be stimulating increased investment in AI, which is the rationale for thousands of job cuts that have been announced in the last few weeks.
Yeah, I don't think interest rates are an important part of the AI of the data center story. I think people think they're great economics in building these data centers, and they're making a lot of money building them, and they think they have very high present value and all that sort of thing. It's not really about about 25 basis points here or there. We use our tools to support the labor market and to create price stability. That's what we do. That's our two jobs, right? So we're here by lowering rates at the margin, that will support demand, and that will support more hiring. And that's why we do it. Now, no 25 basis point or even 50 basis point hike is going to be a dispositive thing, but ultimately, lower rates will support more demand, and that'll support hiring over time. And of course, we also have to be careful about this, which is what we've been doing, because we know where inflation is, and we know that, I've told you the story. It's a complicated story, but this is the best assessment that we can make. Because there's uncertainty around inflation and the path ahead for inflation, that's why the pace we're going has been a careful one.
Victoria.
Hi, Victoria Guida from Politico. On AI, I'm just wondering, it seems like a lot of the economic growth that we've been seeing is fed by investments in AI. So how worried are you about what a sudden contraction in tech investment would mean for the overall economy? Is there enough strength in other sectors? And specifically, are there any lessons that you take from the 1990s in how you might approach what's happening right now?
Yeah, this is different. In the sense that the companies that are so highly valued actually have earnings and stuff like that. So if you go back to the 90s and the dot-com, these were ideas rather than companies. And, so there's a clear bubble there. Whereas I won't go into particular names, but they actually have earnings, and, it looks like they have business models and profits and that kind of thing. So it's really a different thing. The investment we're getting in equipment and all those things that go into creating data centers and feeding the AI, it's clearly one of the big sources of growth in the economy. Consumer spending also, though, has been, is much bigger than that, and has been growing, and has defied a lot of, negative forecasts, continuing to do so this year. Consumers are still spending. Now, it may be mostly higher-end consumers, or maybe skewed that way. But the consumer is spending, and that's a big chunk of what's going on in the economy, substantially bigger than AI. You could point to growth. I mean, actually, growth as opposed to level, but consumer spending is a much bigger part of the economy.
And why do you think that the labor market is slowing so much, even though consumer spending is strong?
Why has it slowed so much? Well, what's happened is that the supply of workers has dropped very sharply due to mainly immigration, but also lower labor force participation. So, and that means there's less need for new jobs, because there isn't this flow into the pool of labor that, where people need jobs, because there aren't those people now. So there's not a supply of workers showing up for jobs. In addition, demand has also gone down, and so has labor force participation has declined, which is more of a sign, in this case, of demand as well as trend. So I think you're seeing some softening. The economy's growing at a slower rate than it was, 2.4% last year. We think around 1.6% this year. It could have been a couple of tenths higher if not for the shutdown. And of course, that will reverse. But you still got the economy growing at a moderate pace.
Andrew.
Hey there, Andrew Ackerman with the Washington Post. I wanted to ask if you could elaborate on how you think about policy in the context of the data drought. Does it make you inclined to stick with your plans as set out in September in the absence of the data that might change your mind, or does it make you inclined to proceed with added caution because of uncertainty?
Yeah, well, we'll know when we face that question, if we face that question. It'll probably be argued both ways, right? But I've said a couple times here that, if you really aren't getting information you really don't know, and the economy looks like it's solid and stable and hasn't really changed, there will be an argument. I don't know how persuasive it will be, but there will be an argument that, you slow down when you can't see as far ahead. Others may argue, I'm not sure where this argument will come, but you're perfectly right that you could also argue, well, things haven't really changed, but you might not know that, So I don't know whether we'll face this or not. I hope we don't. I hope by the time of the December meeting we're getting, a better flow of data. But if we're going to have to do our jobs one way or the other.
Okay. I also just wanted to ask a FinReg question. I think several years ago you said the overall amount of capital in the system was about right. As the Fed moves forward with a revised Basel proposal, potentially changes to the GSIB surcharge, has that changed at all? Or are you planning to significantly reduce the amount of capital in the system? Thanks.
So there are discussions going on, I think, among the agencies, and I don't want to get ahead of those discussions. I continue to think that the level of capital, when I said that in 2020, was about right. And of course, there's been much capital added since then through various mechanisms. But I look forward to I know those discussions are really just getting going. They haven't come to the point where they're got a whole plan and that kind of thing. So I really don't have much to say on that.
Brian.
Hi, Chairman Powell. Brian Chung with NBC News. Is the weakness in the jobs market accelerating, and who's at risk if the interest rate cuts are not the effective medicine for a further slowdown in the labor
So
market?
we do not see the weakness, as you put it, the weakness in the job market accelerating. I would say, then again, we didn't get the September employment report, payroll report, but we look at, the unemployment insurance claims, initial claims are reported at the state level, and we still get those, and we can accumulate them and get the national number. And there's really, no story. You can look at the numbers. Same thing with the job openings we get from Indeed. There's just no story over the last 4 weeks. It's kind of stable. So you don't see anything that says that the job market is, or really any part of the economy is making a significant deterioration. Don't see that. You see more things like I mentioned, though, which is that, you see big companies making announcements of either of layoffs or of the idea that they won't need to hire. Their number of employees is not expected to go up over a number of years. There may be different people working there. They say that too, but they don't need a bigger head count. So you see those kinds of things. You don't see it in the aggregate numbers. The layoff numbers have not gone up, but job creation is very low. And the job finding rate for people who are unemployed is very low. But the unemployment rate is very low as well. 4.3% is a low unemployment rate.
So as you make these cuts, is it the lower income workers that you're thinking about, or those who might have their jobs automated? Is there a particular
That we're
section
thinking
of the
of?
labor market that you're particularly?
So we can't, our tools don't allow us to target any demographic or any income level and that kind of thing. I do think that people, we saw this during the global financial crisis and the long recovery. If you have a long period of very strong labor market conditions, it benefits people at the lower end the most. The last 2 or 3 years of that long expansion, people at the lower part of the income spectrum were getting the biggest benefits, and lots of things were happening in that space demographically, which were very constructive. And we're not at that place right now. But so, yeah, a stronger labor market is the best thing we can do for the public. It's also part of our job. It is half of our job, but it is absolutely the best thing we can do for people. Along with keeping prices stable. Those two things. Inflation also hurts people on fixed incomes more than other people.
Courtney.
Hi, Chair Powell. Courtney Brown from Axios. As you know, the 12 Reserve Bank presidents' terms are up for renewal at the end of February. I'm wondering if you can give us a timeline for when the board will consider those reappointments and whether we can expect everyone to be re-upped or if we can expect some changes.
So it's a process that we go through under the law. The way the law works is we have a reappointment process every 5 years for all of the reserve, each of them and all of them. We're in the middle of that process, and we're going to complete it in a timely way. And that's really all I can say.
Okay, thank you.
Daniel.
Daniel Davis, Agence France Presse. You've now had dissents in 3 consecutive FOMC meetings, but in this meeting you had dissents going in both directions, and you've just mentioned there's strong disagreement over the future path of rate cuts. Have these disagreements complicated your role presiding over the FOMC meetings, and if so, how?
I wouldn't say that, no. I think you have to take what comes, and what comes right now is a pretty challenging situation where we have, first of all, we have 4.3% unemployment. We have an economy that's growing close to 2%. So, overall, it's a good picture. It's a good picture. But in terms of our policy, we have upside risks to inflation, downside risks to employment, and this is a very difficult thing for a central bank because, one of those calls for rates to be lower, one calls for rates to be higher. We can't do both, so we have to balance the two, and so it's a challenging thing, and as we have worked our way through this process, you would expect that there would be a range of views across the committee on what to do and the speed with which we should do it. And that's what we have. That makes a lot of sense to me. All of these people are, people who take their jobs very seriously, work very hard at this, and just want to do what's right for the American people, but they have different views on what that is. And, it's an honor to work among people who care that much. It is, but I don't feel that it's unfair or anything like that. It's a time when we're making quite difficult judgments in real time, and I believe we'll get through this, and I think we've done sort of the right thing so far this year. I think it was appropriate for us to be careful about this. I think it would not be appropriate to just ignore or assume away the inflation issue. At the same time, I think the risk of higher, more persistent inflation has declined significantly since April. And if we do wind up resuming rate cuts at some point, we will at some point. I think we're trying to get to the end of this cycle with the labor market in a good place and with inflation, on its way to 2% or at 2%. So that's all we're trying to do, and we're doing it under, quite challenging circumstances and doing the best we can.
We'll go to Jennifer for the last question.
Thank you so much, Chair Powell. Jennifer Schonberger with Yahoo Finance. Both regional and large banks have taken losses on loans given delinquencies on subprime auto loans. JP Morgan CEO Jamie Dimon warned, when you see one cockroach, there may be more likely. I'm curious how the Fed is looking at these loan losses and if it poses risks to the financial system or the outlook for the economy. Is it a warning sign?
So, we're obviously we watch these things very carefully, credit conditions very carefully. You're right. You've seen rising defaults in subprime credit for some time now, and now you've seen a number of subprime credit, automobile credit institutions having significant losses, and some of those losses are now showing up on the books of banks. We're looking at it carefully. We're paying close attention. I don't see at this point a broader credit issue. It doesn't seem to be something that has very broad application across financial institutions. But we're going to be monitoring this quite carefully and making sure that is the case.
And then separately, many, you yourself have said that we're in a bifurcated economy right now with high net worth individuals continuing to spend with the lower income pulling back. How much of consumer spending continuing hinges on the stock market remaining strong? In some odd way, does the market help keep the economy buoyant?
So there's some relationship there, but remember, the more wealth someone has, the lower an additional dollar of wealth matters. So your marginal propensity to consume declines quite dramatically as you reach levels of stock market wealth. So, the stock market, it would affect spending if the stock market went down, but it wouldn't drop sharply unless there were quite a sharp drop in the stock market. People at the lower end of income and wealth have a much higher marginal propensity to consume of an incremental dollar of income or wealth, but they don't have the stock market wealth. So I think it's certainly a factor supporting consumption right now. But you would see it if you saw a material correction in spending, but it wouldn't be. You shouldn't think that it'll dollar for dollar stop consumption, because that wouldn't be the case. Thanks very much.
Oh my God, bro. Yo, I'm not gonna lie. I'm usually like super into this shit. Dude, today I was just like, nah. Golly. Maybe I'm just tired. I don't know, but okay, what's going on? How's it going? All right, I'm gonna break all this down for you. First and foremost, shout out to my G, Shafiq Yunus. Just got off work. What did I miss? I'm about to go over in a second, so welcome in, G. Yo, I haven't spoken in like an hour, which is like a long time. Okay, let's talk about it. Okay, how do I even want to? What do I want to even? How do I do this? Okay, so I made a tweet because I was bored. So let's go over that first. You know what? No, I'm going to just go over the whole thing. So I was taking some notes. First and foremost, so here's the big three. The big three things you need to know from the meeting today. Firstly, quantitative tightening is ending, but we are not entering into a period of QE yet. Quantitative easing, we are not entering into QE yet. QT is ending. QE is not starting. I will explain that in a second. Okay. The second thing is he made a very clear point that people should not bet 100% that interest rate cuts in December are going to happen. And at the very beginning, it sounded like, hey, we're not cutting interest rates in December. And it seemed like he was almost trying to warm the market up to this. But then he went on to say that it's mostly based on the shutdown and the uncertainty and the fact that different members of the Fed are going to have different risk tolerances with different views, and all that crazy shit that's happening could, of course, cause a vote to go into the direction of just slowing down. You know, if the shutdown continues, things with China continue, they might need to slow down, and that a rate cut in December is not a 100% guarantee. Okay. So these were the two biggest things. These were the two biggest pieces. So let me break down each one of them and what they mean. So yes, quantitative tightening is ending as of December 1st. What does that mean, though? That does not mean that quantitative easing is going to start. Let me explain why. I'm going to make this as simple as possible. Let's imagine that the crypto market is a water bottle. The crypto market relies on that water bottle having as much water in it as humanly possible. The more water that is in that water bottle, the better for crypto. Okay. Now, the Fed, they can control how much water is in this bottle. They can take water out of it. They can put water in it. What they've been doing over the last couple months or last year or two has been taking water out of the water bottle. And by taking water out of the water bottle, it's been negatively impacting crypto and many other asset classes in general, but more specifically risk on asset classes. Okay. So they've been taking water out of this bottle. Now, what they're doing is they're saying, hey, we're going to stop taking water out the bottle. Does that mean that they're going to start putting water in the bottle? No, but it means they will stop taking water out the bottle. So we're in an in-between phase right now where just because they're going to stop taking water out the bottle does not mean they're about to start putting water in the bottle. Let me translate this into real terms. Quantitative tightening is the reduction of capital and liquidity out of the economy via their balance sheet. So what they're going to do is stop doing that, but they are not going to start increasing their balance sheet, which basically involves injecting more capital and liquidity into the economy. Okay. So please understand the difference there. Please understand the difference there, which is what I made a tweet about in the middle of this. You got to understand that difference. Now, he did say there will be a period in time in which, because they freeze it, meaning they don't put water in, they don't take water out, just because they freeze it, it'll naturally reduce the balance sheet itself. Okay. And I'm not going to explain why that happens. Don't worry about it. And because of that, even though there will be like this little transition phase in between taking water out and putting water in, there will be like a slight reduction. Okay. They're going to need to add water in at some point, is what he said. Or in other words, eventually they will need to do quantitative easing, or naturally quantitative tightening will continue. So yes, QE will happen at some point. He didn't say when, but it did sound like soon, kind of, is what it sounded like. Okay. And so, yes, this is a good thing for crypto, but it's not the best thing that can happen yet. Okay? I hope you understand. Put a 1 in the chat if you understand what I'm saying. It's very important you understand that because it's not the same thing. Okay? Now, the second thing. People freaked out because he said, well, we're not basically, he said it is not a 100% guarantee that, okay, perfect. Everyone understands. Great. So he said it is not 100% lock that we're going to cut interest rates in December. Now, many people took that and ran with it, which is why the crypto market dumped. Because people were like, oh my goodness, they're not going to cut interest rates. No, it's not because of anything. It's solely because they said, listen, we trying to simplify this. Weird shit is happening in the government right now. We're seeing a government shutdown, which means we're not getting data, which means we can't do our job as effectively as possible. And because we can't do our job as effectively as possible and actually have an understanding of what's happening to make an informed decision, we don't want to risk making the wrong decision as a result of what's happening in the government. So therefore, there is a chance that come through November, if the government doesn't get their shit together, we might need to slow down. So we're far from being 100% guaranteed that an interest rate cut is coming in December because we don't know what's happening. We're working really off anecdotes. We're not actually looking at quantitative, definitive data right now that says this thing is happening or this thing is not happening. So we may need to slow down and not do anything and just see what happens. We're going to end QT December 1st, and we may just need to go from there. But I am under the assumption, based on what I heard him just say, that if the government gets their shit together and we can start to get some real definitive data on what is happening, they will continue on track for what they've been doing. Okay. So that's what just happened. So I'm seeing a whole bunch. I was scrolling Twitter through all this and people are misconstruing everything that just happened. That's what just happened. They might need to slow down if the government doesn't get its shit together, and they will be ending quantitative tightening, meaning they're not going to take water out the bottle anymore, but they're not putting water in the bottle. So this is slightly good. It's not bad this is not bad. Nothing he just said is bad for crypto. It's a little bit better than neutral, but it's not great yet. Slightly good. Cool. What the fuck is that? I don't know what just happened. But does that all make sense? Please put a 9 in the chat if that makes sense. I just want to make sure you all understand. Okay. Cool. Awesome. Whoa. Happy New Year, Bush. Okay, cool. Okay, we all get it. 9. Okay. Okay. Cool. Okay. All right, perfect. So, what does that mean for our thesis? What does that mean for how we view the crypto market right now going forward? Nothing changes. Absolutely nothing changes at all. My genuine understanding or my genuine belief around this market is that short term will be chaotic, mid to long term will be bullish. So, what did he just do? He just added more uncertainty into the short term because people now don't know what's going to happen with tariffs, what's going to happen with the government shutdown, and how that will impact his decision. He's saying there's a lot of shit going on. It needs to be sorted out before we make a move. And if it's not all sorted out, we're not doing anything. So now we do not know what's going to happen in about 6 weeks. So it creates more short-term volatility. But he even said himself, this is just a blimp in time. It's just a moment, right? It's just a moment of weird shit going on. So he even himself is expecting mid to long term, none of this stuff that's happening right now will have a massive impact on the general trajectory that we are on. So all this did today was confirm the thesis that the short term will be very chaotic, very volatile. We might pump, we might dump, liquidations will occur. We get it. It's fine. But mid to long term, we are still moving in a good direction. It didn't work. Oh, it did work. There we go. Are we all on the same page? I need to make sure we're all on the same page. Okay. So that's that. That's that. I'm going to make a YouTube video after this live stream ends in a few minutes and go over it again so you guys can go back and watch it. Okay. Don't worry. And watch that video, by the way. Even if you watch the stream, go watch that video. I need the views. Leave me alone. Okay. There was something else that I wanted to mention. Oh, okay. Yes. Crypto. Yes. This did just happen. Yes. The market fell from 111K to 108K. Yes, that happened. No, it is not a big deal. What did we say, chat? Some of you were here about an hour ago. If you heard me say it makes sense for crypto to continue downwards to liquidate these long traders before stabilizing, if you heard me say it makes sense for that to happen, put a yes in chat. Just make sure you all heard that. Because yes, we talked about this. The market was stabilizing. It built up a key structural support. We saw liquidations heavy to the look. You know what? I left it open. I literally left it open for you to see. So an hour ago, this is what the liquidations looked like 1 hour ago. And I said, listen, what happens right here? Do you see all these liquidations? I said it would make sense for crypto to come down and keep continuing to take out these long traders and leave all of this long-term upside potential open. That's what we spoke about 1 hour ago. Go fact check me on this. Let me reset it. So now I'm going to press this refresh button, and you're going to see what I mean. And just watch. Here we go. Now, do you understand what I meant? It just got cut by about 40%. So you saw how we had two huge levels of liquidations? It already just took one out. So the market just came down and took out that level of liquidation on the 7-day Bitcoin chart, just like we talked about days ago, which is going to open up the door of opportunity to the upside because now people are betting that the market's going to go down. So what next? The short term will be chaotic. It very, very well might come back down from here and take out the rest, which is around 107.8K, which would look like a move like this. It is possible. What just happened was that we built up short-term liquidity right here. You see this little range that we're in right here? We fell below it. We came back up. We got rejected off of it. So Bitcoin's price right now is coming back down to try to find some support to try to reapproach. If it fails the support, coming back down and liquidating all of the rest of those 7-day traders is very, very reasonable. It's very reasonable. Okay? So don't be surprised and scared if Bitcoin comes back down a little bit more to take out the rest. It's fine. Look at the 1-day. Look at the 30-day. It's fine. Look at Hyperliquid in the macro. It's fine. Okay? All right. So, everything that we basically said was going to happen has now happened. Our thesis has been further validated, and the game plan remains the same. In the short term, buy the lows, take profits on the highs, on Bitcoin, ETH, Solana, XRP, etc. Scoop the lows, sell the highs over and over and over again until we get to the mid to long term, at which point we get through this bullshit with China, through this bullshit with tariffs. We start to see what the Fed's decision will be. We hopefully and ideally enter into quantitative easing, which is when they're putting water in the bottle, at which point liquidity should flow in the direction of crypto through Bitcoin and top altcoins down into your smaller altcoins, at which point we can see growth. We're already seeing the natural trickle, but we don't have enough liquidity as a result of what's happening in the economy to actually stimulate growth amongst smaller alts yet. It's not here yet, but I do believe the day will come. And this only confirms that thesis more. I may be wrong. We may be going into a bear market. I might just lose on this one. It is what it is. I'm not scared of bear markets. I really like bear markets because everyone just shuts the fuck up a little bit and we all just buy crypto and make a lot of money a year later. Are we all on the same page? I think we're all on the same page here because I'm about to go in a second here. I'm about to go eat because I'm starving. I just want to make sure you get me. I want to make sure you guys get it. Okay. All right. Cool. Okay, we're all on the same page. So this is what I'm going to do. I'm going to go eat. I'm going to make a video explaining this one more time. So go watch that video, like that video, subscribe. Before I go, a couple things I want to show you real quick. Don't forget, if you want to get access directly to me, let's see what I'm doing, what I'm buying, what I'm selling, when I'm doing it. We've been nailing this market for over a year now. Go to the school. The school has workshops, courses, classes. We're releasing coaching in 2 weeks, which comes with mentorship and one-on-one coaching where you can learn directly from me. It's all going to be available over in the crypto school. It's $100 a month. It is worth the money. Check out the link down below if that's interesting to you. If you are trading, sign up on BTCC. You can get some really cool bonuses. Follow me on Instagram, The Life of Tyler Hill, to see what I personally am doing and get some extra content from me. And do not forget, if you want to learn more about how crypto works, go to Tyler Teaches Crypto. All of these links are down in the description below. So all in all, I hope this makes sense. I hope I've kind of clarified this for you. Let me know. Fireworks one more time. There we go. I hope you guys do good. I'll be here every step of the way updating you. I hope you guys have an absolutely fantastic day, and I'll see you all in the next one. See you later, everybody.